Okay guys, welcome back to a collab video that we do every fortnight with Wolves of Crypto. Wolves of Crypto and I put a lot of effort into these videos. We try and make it the most, cohesive and fundamentally educational content we can for you guys. So thanks for tuning in, of course. And Wolf, we got a lot of stuff to talk about today. Is that correct?
That's right, we do. Now, a lot of people have been waiting for this one, I think, on both of our channels because they've noticed that, it's hard to explain, but they've noticed that we have different forms of analysis as we head towards the potential macro bottom for Bitcoin. And I think that a lot of people think that we're in strong disagreement with each other. I don't think that's necessarily the case. We do have points of which both of us would probably slightly disagree with the other's analysis. But we're going to be covering all of that, having a discussion about, and hopefully coming to a conclusion about where and what would entail a macro bottom for Bitcoin and also the broader markets in general. So let's get into it, I think. What do we want to start with, Well?
I think we should talk about just the charts first, talk about what's happening with Bitcoin currently, maybe move to the larger time frame, then talk about, that 9-year trend line that everyone wants to hear about. Talk about that. I'm going to let you kind of rebut that to start off with, maybe do a bit of a discussion. You can talk about why you think it won't hold, why you think you're a little bit more leaning towards that break downwards. Then I'll kind of come in and talk about why I think we need to be giving it a little bit more significance than probably what the majority of the market is currently viewing it as. A lot of people right now are thinking, well, either you're bearish or you're bullish, but simply that's not really the case. Sometimes you can look at the chart and be like, okay, I'm going to take more of a neutral stance here. I'm very much aware of the downside risk, which will be triggered by these certain events, but I'm also aware of the potential upside possibility. I think from there we'll go into the economic breakdown, talk about how the economy could perhaps trigger that breakdown of that 9-year support, what that will actually cause for Bitcoin, what that would result in for the cryptocurrency market, what price targets we have for that. We'll talk a bit about that together. And then I will talk about, on the flip side, how the economic situation actually directly impacts cryptocurrency. We use a variety of new charts to show you that. And hopefully by the end of all of that, we'll have a nice, I would say understanding of where we think the price is going, or if not, at least a new view for each other on where we think the price will be heading.
Yep. Okay, cool. Sounds good. All right. So I'll just jump in straight into the analysis here and just go something like the daily chart. Perhaps we can talk about the weekly candle as well. Now, here's my daily chart. This is what I've got. So I'll just explain it quite quickly. So essentially what I've got here in the daily chart is a major rejection box here, which is this red box, which is stemming from around 33 to around 28.6. In my opinion, we would need to get over that box in order to confirm some sort of trend confirmation. I guess you'd say a reversal confirmation. Now, I have been very precise and very clear in saying on my channel that although I do have speculations as to where the bottom will be, I'm not confident in any of those speculations because I know that it's pretty much entirely out of my control. What I'm saying is it's very hard to catch the exact bottom in every occasion, just as it's very hard to catch the exact top in any occasion. And so I'm more focused from a trend reversal, and I'm more focused on finding the bottom after the fact, simply because it's very hard to catch during the fact. So what we have here on Bitcoin is this red box. Once we get above that, I'll be pretty confident that the bottom will be in. I think that until that point, until we get above that red box, in my opinion, I think anything could logically be labeled a dead cat bounce, and you'd still be speculating as to whether that bounce and where it stemmed from was the bottom. And below that, we have some major support lines. I'm looking at 23.8K, I'm looking at 22K, I'm looking at 19.7K, which is a 2017 all-time high. I'm also looking at around 17K, which is the recent low of this drop, which actually kind of, I think, probably lines up perfectly with that major 9-year uptrending line that you've been looking at quite a bit. And then lower down here, I've got a major green support box, which would have to act as support in the occurrence in which we drop below that major uptrending line, which we'll look at in a second. And that's stemming from around 14K to around 12K. So yeah, that's kind of where all the important levels are. And then zooming in on Bitcoin even more and looking at the actual structure that we're in, I've got this shorter term, it's not actually shorter term, but I know that there's a larger descending wedge you could possibly draw. But there is this 3-month long descending channel formation, which is actually a bullish formation, which may support that potential bottoming out theory. However, what we could see and what I would propose is that we could just see a bounce up, a dead cat rejection, and come back down to something like this. That is also a possible scenario. So it doesn't actually confirm anything in my opinion, but it is worth having there for resistance and support. So we've got a descending channel And then zooming into the shorter term, the hourly chart, I've actually got this as some sort of bearish pennant formation. I'm not necessarily entirely convinced that it's going to break to the downside at this point. I think maybe it is very logical that we have some sort of bounce, but it's just there just so we know what's happening in the shorter term, and that is due for a breakout probably within the next 24 hours here. So we will be seeing some sharp price action. And I'll just say one more thing. The reason why that's interesting is because we have on the weekly candle, if we can get to a weekly chart, what we can see is that we have just about 3 days left until the weekly candle closes. And provided this triangle or pennant, whatever you want to call it, breaks to the upside, we could actually be getting back above the 200-week SMA in time. And that would label this drop below at a fake out, which would be very interesting. And that would actually kind of further bolster the opinion that perhaps the bottom is in, even regardless of the macro situation. So it's interesting stuff for sure. That's what I would say about the current situation. Do you have anything to add to that?
Yeah, well, I've got a lot to talk about, but I guess before we get into anything, I did hear you mention, obviously it's much harder to catch a bottom than the top, and I just want to go ahead and say that couldn't be more true. The top is generally quite easy to catch because you have indicators that can allow you to really predict exactly what's going on. But when it comes to the bottom, your technical indicators are lagging. They're mostly always lagging. So utilizing macro structures, trend lines, market patterns are historically more accurate when it comes to predicting these bottoms. I do want to talk about this. Is it the 200 moving average you got here, of 300 moving average?
200 week, yeah, the 200 week SMA.
Yeah, so the thing about moving averages, and I guess the thing about, actually, I'll screen share if you don't mind. I'll go back to my chart.
Sure. There we go.
Trying to figure out which one it is. Which one is it? It would be... maybe, I've got no clue which one it is. It might be this one here. There we go. Okay, this one's it. Cool. So the thing about this is, first we have to talk about that 9-year trend line. I guess you've just said that you think you hold a little bit more significance to that moving average than you do the trend line. Is that correct?
I think that I'll probably talk about it a bit later, but what I would say about it just briefly, I don't want to interrupt you, but what I would say about it, since you brought it up, is that I think the reason why I hold more significance to the 200-week moving average rather than the trend line is because the 200-week moving average has had more retests than the trend line, and it's been retested for longer on each period of retest than the trend line.
Cool.
So yeah.
Going off that, I just want to go ahead and say, I assume you already know this, but a moving average is just not a support. And the reason a moving average is not a support is because it is the average price over a period of time. So it's kind of like one of those things where it can give you a false sense of hope, because if you have a price consolidating at a specific level for an extended period of time, the moving average can appear as support. That's correct? So over here we have like this how many months period over here, like a couple month period over here, where we have the price kind of appearing like it's acting as support on this moving average. It's not actually acting as support on this moving average. This moving average is actually representing the support of that zone. It's a big difference. So it's not that the price has found support on the moving average, it's the moving average is reflecting that the price has found support. So if we go ahead and look at the moving average across the time, we can't say the price is going to find support on a moving average because it's not a support. We have to assume price will find support on actual support trend lines. The moving average is just a price point in which we could potentially find some buying pressure or buying volume in comparison to previous price points. So when we look at that 200-day moving average, we don't expect a bottom to be on the 200-day moving average. We do expect a bottom to be on a trend line, and we do know that in history we have seen price stabilize above a trend line, or above that bottom trend line, which has been represented by that 200-day moving average. So I think it's kind of like
I agree.
A little bit like the other way around. If like moving averages aren't really supports, they're reflecting support. It's like a little bit different. So I guess we talk about this log line, right? This 9-year trend line, which everyone's kind of like up in the air about. Some people agree with me, some people think it's wrong, some people, think it's going to go down, some people think it's going to go up. I just want to say one thing. This trend line is incredibly significant, and not only significant in terms of bull market, bear market bottoms. We have seen, every single bear market so far retest this bottom line and find support here. We actually bounce from here. it's not only significant in terms of that, but it's also significant in terms of the entire macro structure of the market. You know, what happens if we lose this trend line? We've lost a very significant uptrending line. And support is assumed to be support until it's not. And I know you can agree with that. You know, price moves between support and demands. That's why we have our targets. That's how we came up with these targets in the first place, because we identified that price will move between support and demands. We are at support now. And regardless of whether you think the economy will result in the price falling down, regardless of whether you believe personally, you know, it's going to go to 12K or whatever, the fact of the matter, it remains above support, and therefore we have to be open to the idea that this could potentially be the bottom. So that's basically my stance right here in terms of the macro chart. And obviously I do have my invalidations, and I'll just go ahead and bring some stuff up. Like, for example, I posted this chart a very, very long time ago, you know, making everyone aware that, you know, I do think if we do lose that trend line, we can see, you know, $12,000, $13,000. And, you know, it made a significant push down towards this level. So, you know, like, you can be optimistically bullish while still having bearish targets and having invalidations. But I think trying to, or should I say, blinding yourself to potential upside when we are at an objectively strong support, which has marked the bottom of 2 bear markets, is not the best idea. I think at bare minimum, you should be open to the idea that we can go upwards. What do you think, Wolf?
Okay. Yeah. Well, I 100% agree with that. Right. Now, I've talked about on the channel a lot, as I said before, that I'm not actually confident in any sort of prediction on the market. So when I say, I would say my personal opinion on Bitcoin right now is that the most likely bottom, in my opinion, is going to be somewhere between 12 and 14K. But I also said that there's very, very minimal amount of evidence to suggest that's going to be the case. That's just kind of speculation based off minimal data. So I've said that, hey, it's very likely that the bottom could actually be in here. It's very likely that this major uptrending line on a 9-year basis could actually be in here. The reason why it's hard for me to accept is because a lot of my analysis stems off of kind of macro trends in the sense of the 4-year cycle theory, which is a date range trend that suggests the bottom will be coming in Q4. And then on top of that, and none of these pieces of evidence would be significant alone, but on top of that, it wouldn't be illogical to assume, in fact, it's probably more likely that the macro situation will not be getting better until Q4 as well. So I think that I've heard you say before, and I know you're going to look into it in a second here for sure, that you know, it's hard to kind of predict what the Fed's going to do, because they could just, you know, do something completely unexpected. That's completely correct. We can't be certain about whatever the Federal Reserve is going to do, and hence we can't be certain about the direction of the macro situation, because the macro situation directly derives on what the Fed does. But if we're using probabilities and we're using our best guesses, I would say it's unlikely for the macro situation to look better until at least Q4, and that lines up with the 4-year cycle theory. And hence, in my opinion, it would be logical to assume that the bottom is not in, purely because of the fact that it's not Q4 yet. But that would be my opinion.
But do you see, Wolf, how that there's a lot of assumptions in the argument? Like, I'm not saying that's definitely wrong. That's 100%, like, that's a total possibility. And we're very much aware of interest rates continuing to rise, and that will result in that scenario. But it is still basing off assumptions. If we're looking at the chart with no assumptions right now, ignoring everything else, this would technically be the point of which we have bottomed 2 times in the past. And therefore, we have to be open to the idea that it will occur again. So
yes, I agree. And I'm very much open to the idea. And actually, I want to bring up a chart that kind of supports the fact that the bottom will be in, which is probably not what people would expect from me here. Now, I have talked about before that Bitcoin, obviously, in a daily chart, this is going a bit short term. It's in a bullish structure. And then we've also got the potential for a bullish break here, which would get us back above some critical levels. Now, you did say before, and I do agree with you on this, but I would like to point out as well, although the 200-week SMA and although moving averages in general are not kind of causes for direct support and resistance, I think at the end of the day, you know, buying and selling does directly move the price. So if a lot of people get the impression that a moving average is a direct cause for support, it's going to be a snowball effect, and it is actually going to psychologically turn it into a support zone. Do you understand what I mean there? I don't know if that makes sense, but
no, 100%. Like that's 100% correct. You know, people definitely place buy orders at these points of perceived support. The statement was more or less, I think, in comparison to me, you're putting more significance on that moving average in comparison to the actual support line, where I'm putting more significance on the support line in comparison to the moving average. I think that's where we kind of differ a little bit in our, I guess, points in regards to the current price action.
Okay, so here's what I want to talk about. If I'm ignoring the date ranges, right? Because a lot of my prediction is actually based off date ranges, right? If you look at me and you wipe the 4-year cycle from my brain, I would basically agree with you entirely. I would say this is very likely to be the bottom. I know you're not exactly saying that, you're just looking at the charts objectively, but I can't get that out of my head. You know, there's date ranges, they haunt me. But essentially, this is something that would support the theory that the bottom would be in here, and this is the 300-week moving average. Now, this is a place in which we've wicked to in the past, and you know, the 300-week moving average is very much supporting this line, and we could actually see, obviously, a little potential wick below this line, but eventually, you know, holding it on the weekly candle close or whatever, see a fake out. That's very common on macro lines like this, and so that would support it. And again, just like the 200-week moving average, we've never dropped below this line. I mean, we have dropped below the 200 before, obviously, but we've never actually even wicked below this line, so that would support it a little bit more there as well. I do want to say that one thing about logarithmic lines, you know, straight lines drawn on logarithmic charts, that do kind of make me uncomfortable. And this is all said as a little counterpoint, right? I do actually think this line is significant. I am watching this line very closely because if it wasn't significant, we wouldn't be bouncing off of it. It's as simple as that. I mean, it's very clear that this line is valid because
about a 20% bounce off of it already. Yeah,
that's correct. Yeah, it's clearly valid, right? It's clearly something we need to look at, even if we don't think the bottom is in. So yeah, I do think it's significant. But what I would say is that on a long-term basis, right? So we're talking decades here. It is mathematically impossible for this line to continue holding to support, and so at some point it needs to break. And so it isn't irrational to have speculation on when that would be. And I think that's kind of what I'm basing it off there. Would you agree with that? Because
no, obviously you're entirely correct. Log scales, the line can't just continue forever. That's completely correct. But like I said, support is support until it's not, and like you say, the trend is your friend. You know, like technically, when support is support, you have to be more open to the idea of a bounce at support. But generally, people are more bearish at support and more bullish at resistance. It's like, I know a lot of people are going to say, oh, it's like the all-time high. But if you remember back at all-time high, you know, I was clearly telling everyone, you know, the tops in. That is when we saw these absurd predictions of, you know, 150K, you know, like 400,000, whatever. But what I'm trying to get at is the lower we go here, even if we lose this level, the lower we go, you're going to start seeing lower and lower and lower predictions. And you just have to remember that everyone has an opinion, but not everyone has data to support their claims. And anyone can just throw around a random number. The thing is, this support line, this 18K line, as we've talked about, is not just a random number. Regardless of whether it holds or not, regardless of whether it marks a significant bounce, it marks a bottom, or it loses this level, it doesn't, I'd say, discredit the significance of this line. And that is all I'm really trying to advocate here. I've had a few people say, oh, Whale, why do you think the bottom's in? Well, I clearly don't think the bottom's in. I don't have a personal opinion. I don't rub my personal opinions on the market. All I'm saying is, the chart is telling us that this line is an incredibly significant one and has marked the bottom 3 times, and therefore we have to plan for a potential bottom. I'm not saying the bottom's in. If I thought the bottom was in, I would have gone all in, but I haven't done that because I don't think that is 100% the case, because I am aware of the macroeconomic scenario, which we'll talk about later in the video.
Yeah, that's entirely correct, right? And I think that's where I get into this kind of point that really makes people uncomfortable. And I've said it before in one of my videos, and I said that I'm not entirely, you know, I think you agree, you would probably agree with me here. I'm not entirely sure, actually. I don't really care where the bottom is because I'm not really buying the bottom very massively. I'm buying the trend reversal. And I think as traders, and predominantly we both are traders, that's what you do as a trader. And so in a way, it's like where the macro bottom is for Bitcoin, it doesn't really affect how much money I make. And so it's not really a big concern of mine. I'm just kind of doing it for my audience. And so it sounds ridiculous to say, but that's kind of what it is, right? I'm just being honest. And so what I would say is that, yeah, we could see a bounce off this line. I have kind of lent towards the fact we'll probably see dead cat bounce, which we're already seeing. You know, whether it's a dead cat or not is kind of up for speculation. But I think that we'll probably continue to see bounces off this line until later in the year. That's my opinion. But I'm saying that, like, you know, seeing as we're in a bounce, you should already be profiting from a bounce. And so whether this bounce materializes into a trend reversal, it shouldn't matter whether or not you call the bottom or not, as long as you reacted to the bounce of support. Who cares, right? Yeah, again, I don't know if that makes sense, but that's kind of my view on it. It's like, who cares where the bottom is? Because you should be reacting to bounces until one of those bounces materializes to form the bottom. So it doesn't matter. Yeah. So I suppose I'll let you go on with the. I know you've got some analysis doing the economy and the macro situation. It's very interesting that you'll show me briefly before the video. I'm interested to hear more about that. I'm sure the audience is as well, so I'll let you get into that.
Yeah, well, I would love to get into that. I think one thing I would like to talk about first, so I guess what everyone's kind of thinking about now, and I'm going to have trouble finding my chart. I don't know why I hide it away behind a wrong screen all the time. Here it is. I've got a lot of tabs open. The one question everyone's probably thinking about, and I just want to go on two different tangents here. Tangent number one is we're assuming the bottom's in right now. What should you do? Where would the validations for the confirmation occur? And tangent number two is, if we lose this level, what can we expect and what should you do? So we're going to quickly answer those four little points, and then we'll go to the economic situation. So point number one, at what point can we say with absolute certainty is the bottom actually in for Bitcoin? Because like we talked about at the start, is you can never actually pinpoint or predict the exact bottom. You can only assume the bottom, and then after the reversal happens, like Wolf just said, then you can confirm the bottom. So your confirmation comes after the bottom, just as, you know, like your trading should occur. You shouldn't actually be loading up right at the assumed bottom, because the assumed bottom has a lot of risk, just as we do now. We are at an assumed bottom, not a confirmed bottom. So where would that actually occur? Well, like Wolf said, moving average is a really good one. We want to clear or get back above that moving average. Number two, which supports Wolf's chart, which was about 32,000, we would like to reclaim this uptrending dotted line. So this uptrending dotted line, we would create a confirmed bottom for Bitcoin here. That would be confirmed, and that would initiate a new uptrend. And of course, a new bull market would occur above $48,000. That is when the Bitcoin bull market will start. Not altcoin bull market, Bitcoin bull market. As we can see, altcoins only really start to rally when Bitcoin bounces off this trend line. During this drop, that is when Bitcoin altcoins massively outperform Bitcoin in terms of percentages. It happened in last cycle, it happened in the cycle in 2017, and even again. So that is kind of what we're looking for. How should you allocate your funds? Well, personally, if you followed my channel, you would have already bought Bitcoin down over here, all right? And we said no more than 30% of your portfolio, and we're not buying any altcoins for long-term holdings until we have that first confirmation reversal. You can trade altcoins all you want, like Wolf already does. Wolf trades a lot. I trade a lot. We all have V.I.Ps. We all trade. Continue to do that. For long-term holding, altcoins should not be touched until this occurs. Your major buying, your majority of your purchases should still come after the macro reversal. This is when you have your safest long-term entries of Bitcoin, when the macro trend reverses. All right, I hope that clears it up. So for bearish targets, let's go ahead and talk about this chart over here. And we obviously have a major demand and support zone at this level of here, which is marked, actually, well, let's move it to a 3-day chart, which is marked, obviously, the all-time high, like Wolf were talking about in 2017, this period of contention on the chart, which marked a major area of, you know, stagnation and resistance before we kind of blew upwards in 2020. And of course, now where we've created this nice, you know, doji over here, this long-legged doji candle supporting a nice reversal at this point in time. If we do lose this level, we can expect these lines to be reached: 13,000, 12,000, 9,800. Of course, 12,000 is the POC line on the weekly, with a major amount of historical buying action will occur. It is really as simple as that. So how should you act? Until we lose this level, you should be more optimistic than not. If we lose this level, that is when you can become more confident in this downward price action towards these levels, so on and so forth. Wolf, what do you think?
I think that's entirely valid. Yeah, I think that, you know, I guess trading the trend and trading the levels is the way to go. And whether it's a macro bottom in question or not, you should still stick by your original rationale, which is exactly what I just said. So yeah, that makes perfect sense.
Perfect. Cool. All right. I'm glad we agree. Let's go ahead and talk about the economic situation, because a lot of people, I would say, or I guess the main driving factor that a lot of people are taking into consideration when it comes to losing this trend line is the fact that the economy is very weak, which is an absolute fact right now. And I guess the assumption that the economy is going to continue to deteriorate in the next few months, potentially to 2024, with interest rates continuing to supposedly rise. So with people saying that, they do assume that Bitcoin will fall. And this is not something that we are unaware of. if you remember back to my channel when I first started, even before in our VIP, we were talking about, you know, the impact of impact of interest rates and inflation on cryptocurrency way back over here. We're telling you this was one of our driving factors to why we believe that the price was actually heading down, and this was in fact a resistance, and we used that to you know, tell you that we expect a move downwards to that 200-day moving average, which actually occurred. And Wolf was on the same page. He agreed. He said the same thing. But let's take a quick look at this. And I want to, before I talk about anything else, I want to go ahead and talk about this. Oh, sorry, my bad. I want to go ahead and talk about this chart over here later, and we'll come back to it because this is quite an interesting one that probably a lot of people have never seen in their life before. We'll talk about it in a second. Before we talk about that, I do want to go ahead and talk about the connection between inflation, interest rates, and asset prices, because this is basically what everyone's assuming is going to cause the leg down for Bitcoin. And Wolf, you were kind of talking about that earlier. You think one of the driving factors to why Bitcoin will lose that 9-year support is obviously the interest rates, correct?
Correct, yeah, to a certain extent, yeah.
Cool. So first and foremost, we have to classify risk. So we're going to come back to this word later on. I just want to mention it now, which is systematic risk. And we'll come back and talk about that later. But systematic risk is essentially risk that is out of an investor's control. So risk that is within an investor's control is the type of assets you purchase, the timing of your purchase, the diversification of your portfolio, and asset classes. Those are things that you can control, you know, percentage allocation between assets. What you can't control is systematic risk. So stuff like inflation, interest rates rising, so I got emails coming in, all that kind of cool stuff, monetary policies, fiscal policies, all that kind of cool stuff, right? All that stuff that we hate. So anyway, inflation has been increasing rapidly, right? That's because there's been a lot of printing of money. I think Wolf talked about that in a couple. I remember like a video from like 2 months ago. You were bringing up that chart every other week with you know, the yields and how much money has been printed every single, you know, in comparison to history. But anyway, going on a divergence over here, there's been a lot of money printed in the last few years, which has resulted in high inflation. Obviously, devaluation of the dollar results in higher inflation. All right, what does that result in? Well, it results in higher costs of goods. So costs of goods and services increase, which means people need to spend more money. All right, so how can the government or how can the economy combat this and bring this inflation down? What they do is they increase interest rates. And I've talked about this a lot on my channel. I've talked about this in basically every collab, but we're going to go into more detail in this today. So I want to quickly give everyone a nice little foundation before we go ahead and do that. So interest rates rise. What happens then? Interest on debt increases. So a lot of companies during low credit periods, so when interest rates are incredibly low, which they have been for the last few years, they acquire a lot of assets on low credit, on low interest. So they acquire these income producing assets on low interest, which means they have income producing assets producing future cash flow, which increases the company's valuation, increases the premiums, increases dividends and stock prices, which is why stock prices have increased. But we also have low interest repayments, which means their debt to service ratios are favorable, so they can continue to take these assets. So they're accumulating income producing assets at a low cost. Now, when interest rates rise, however, it flips. We have interest repayments increasing, debt to service ratios decreasing, future cash flows decreasing, and company stock price falling. What happens when their future cash flows decrease and their available cash flow decreases? They need to decrease their balance sheets by offloading risk assets. What are risk assets? Stocks, cryptocurrencies. All right, liquid assets, assets which can be liquidated into cash very easily. So that is one reason why we're seeing cryptocurrency fall massively and why we have seen stocks fall massively. And that's just the companies. We're going to come back and talk about that and show you a visual representation of why that occurs. Moving on, when costs of goods rise, retail obviously needs to spend more money. All right, they need more available cash flow because things cost more money. Not only that, anyone with long-term debt obligations, car loans, house loans, they need to pay more money towards these loans. So now they're going to be more likely to sell their assets to cash, all right, selling their assets to cash, or not investing in assets during periods of high interest to increase their available cash flows to spend on the cost of living and interest. So the economy is not facilitating, it's not only facilitating growth, it's actually enabling, or should I say, resulting in a degradation of growth or a drop in asset prices. Wolf, we've talked about this a lot. You've got a good grip on that already. You talk about that a fair bit on your channel, I assume. But that's basically the know-how. So let's talk about, I guess, you know, how does that actually relate to this chart? Because this is an interesting one, because a lot of people talk about how cryptocurrency and stocks are, pegged together, and that's just not true. Cryptocurrency and stocks are not tied together. They are tied to a singular thing. So they're not technically tied together. They are correlated by a plus 0.7 positive correlation, not perfectly correlated, which means they move as systemic risk increases. If systemic risk increases, cryptocurrency and stocks return changes. Their beta value change. The risk increases and decreases. So we'll talk about this in a second, but first we need to identify what the chart is. So this is earnings, so potential earnings or return over here. We have our risk-free rate, which is the percentage return at no risk. All right. We have our variation or our standard deviation between the two different asset classes, so the correlation between. And we can see on this chart over here, we have our beta, so the expected return on investment or overall risk. The difference between 0.1 and 0.2, the distance between represents the total risk. So the total risk between the assets. The distance between this point, which is stocks, all right, and this point over here is the total systematic risk, all right? The difference in total systematic risk, all right? And the distance in vertical height is not only the difference in return, but also the difference in non-systematic risk. We talked about non-systematic and systematic a few minutes ago. So what have we seen happen? We have seen a scenario where systematic risk has been increasing. Interest rates have been increasing. This has been moving downwards. All right, what does that do? Well, it actually brings this beta higher. So when systematic risk increases, the beta increases for the asset class. And a lot of people get a conception that, cryptocurrency and stocks are correlated to each other or tied or pegged, but that's not technically true. They're not tied or pegged to each other because as systematic risk increases, the returns and risk on both cryptocurrency and stocks increase. All right, the risk on cryptocurrency and stocks increase. So it's not that because stocks are, decreasing, crypto's decreasing, it's because systematic risk is increasing that both of these assets, which are positively correlated, move similarly, not together, they move similar. So that is the correlation between that. So what happens now when systematic risk decreases, all right, goes the other way, we have this decrease in the beta. So the risk between these assets decrease. So how can we relate this to the chart? And a lot of people think, what the hell is Whale even talking about? Well, what is it doing is representing exactly what we talked about here on, I would say, a mathematical chart. And how can we relate that to the Bitcoin chart? Well, if we move down over here and we assume that Feds are going to continue to increase interest rates, we can predict that the beta of these asset classes will continue to increase. The problem with that assumption, it is an assumption that the Feds are going to continue to increase their systematic risk. We don't have a confirmation. They've told us one thing, but there's no confirmation. So what happens if the Feds tomorrow decide, okay, we're not going to increase interest rates by as much next period, and we're going to start increasing our money printing again? What happens? Systematic risk decreases. Overall risk on these assets decrease. They don't decrease because crypto's bottomed. They don't decrease because stocks are bottomed. They decrease because systematic risk is decreasing and therefore returns are more favorable. When returns are more favorable, therefore meaning that the risk reward ratio for these assets are more favorable, people start moving money from cash back into assets. And crypto will produce more returns as it's got a greater systematic risk, a greater total risk, and higher earning potential. I hope that makes sense, guys. It's a lot of stuff to talk about there. But essentially what we're doing is we're providing some economic data or evidence to why the price will move in either direction based on the economic environment. Wolf, do you have any questions or statements or whatever?
Okay, so yeah, I do have a couple of things I want to add. First of all, you're completely correct. Everything you said correct. It's irrefutable because that's just the facts, isn't it? It's not like an opinion. That's what it is. And I think that a lot of people get very like, wait, what? Everything I've been told is a lie when you say that the stock market and crypto aren't, directly connected to each other. I think one way to look at it that kind of makes it a bit easier to understand is rather than them both being tied to each other, think of it that they're both tied to the macro. They're both tied to, as you said, inflation, interest rates, etc., Federal Reserve's decisions, all that. They're both tied to the economy. they're not tied to each other, right? So that's kind of how you think about it. And it's easy to understand why everyone really kind of makes the mistake of saying they're tied to each other. I mean, including myself. And so that's an interesting little thing to kind of just understand a little bit better. And so it's easy to understand they act like they're tied to each other. That's because they're both tied to something else, right? Would you agree with that? Is that an easy way to understand? Do you reckon?
That's pretty much exactly what my chart reflected. It's like they move together based on systematic risk, increasing or decreasing, because they're not both tied to each other, not pegged to each other. It's because they're pegged to the dollar, which is the measure of value of our financial markets. So when people say, do you think crypto will depeg from stocks? It's a fundamentally incorrect question, because the question is more or less, do you think crypto will depeg from the US dollar or the dollar? And the answer to that is, I don't think so, because how could we value if we don't value it to the dollar? Are we going to value it to Satoshis? And if so, what is the value of one Satoshi if we don't value it in comparison to our current financial standard of value or measure of value, which is a dollar? So that's kind of where my stance goes.
Yeah. So I suppose what it comes down to, the way I see it is that, and I think I've made this relatively clear, but I get a question. Okay, so I'll start here. I get a question a lot that says like, well, the S&P 500 sees the future in a sense. The S&P 500 is always one step ahead. I mean, if you look at something like what happened in, for example, I think it was around, like late last year, even before the Federal Reserve started raising interest rates, please ignore this fractal, we're on the logarithmic scale. Even before the Federal Reserve started raising interest rates in December, it started correcting. So it moves ahead of the ball game. And even before the macro situation might start to look good, it will probably start bottoming out as well, right? So it's a little bit ahead of time. In the same way that the Federal Reserve, in when they're changing interest rates, they're acting as to what it will be in a couple of years, right? So, for example, inflation only tops out historically once interest rates start to decrease, because it takes a while to come into effect. It takes a while for those rate increases to actually affect everything. And so, by the time that inflation topped out, the Federal Reserve's already reacted. They've already done their move. They're already starting to decrease interest rates. And so, so going back to what I said, the SPX sees a future. The S&P 500 sees a future. And so my response to that will be that, well, like inflation is the marker and the confirmation of the S&P 500 bottom, because by that time, interest rates will have started to decrease already. So in a sense, inflation has only ever topped out once rates have begun decreasing. That's a given. Therefore, if rates haven't begun decreasing or topped out, the bottom is unlikely to be in, right? So if rates haven't begun decreasing or topped out, the bottom on the S&P 500 is unlikely to be in. And hence, even though they're not directly connected, they are connected to the same macro. So in a sense, if that's the case, it's unlikely for Bitcoin bottom to be in if rates have not topped out or begun decreasing. Now, I said that very sloppily. I'm just kind of freestyling here, but it kind of makes sense to me. And so that's kind of what I see the macro as right now. It's like, well, we don't really know what the Fed's going to do. It's kind of is a bit all speculation. And they're not directly connected. But what we can say is that unless rates have topped out, and in fact, they're nowhere near topping out, right? Because and the reason for that is because they're actually still ramping up, right? They're not just increasing, they're actually still ramping up. We've seen a 75 basis point hike. It's the first hike in 28 years. Yeah, we don't know what the Fed's going to do next, but logically, if they're still ramping it up, we probably can expect them not to just stop increasing in general, right? It's probably at least going to be a slow decrease in the magnitude of the increases before it stagnates. It's not just going to be a sudden, halt to everything. I think that's a fair assumption to make. And so, with that assumption, it's like, well, if the SPX has never bottomed out without rates at least topping out or decreasing, then why do we think Bitcoin's going to bottom out here? That's what I said. That's what I would say to it. Now, it's very confusing to kind of understand. I hope you understood that. Can I just get some clarity? Did you understand what I just said?
Well, let me screen share for a sec, Wolf, because I think what you just said is basically exactly what we were just showing. I just want to say, I can't remember what you just said, but it was something. Rates increasing or something, bottom out. Here we go. I'm going to go back to this chart. What you just basically described is essentially what we were showing here. When interest rates kind of top out, or inflation tops out and interest rates start to fall, and we see inflation start to fall, right? Essentially what that is this systematic risk decreasing. All right. So as we showed you before, if systematic risk decreases, we see the markets start to move upwards. right? So if this line moves this way, systematic risk decreases, the prices of assets increase. If the line moves this way and systematic risk increases, the prices of assets decrease. So it's exactly what we were just showing before, really, just put into a verbal explanation rather. Now, one thing I do want to talk about is that we are kind of trusting, and I talked about this before, I don't want to come off like a conspiracy theorist, because I'm anything but that, but I look at the data and I try to draw connections where other people don't. So what happens if inflation continues upwards, interest rates continue upwards, but the government and the Fed start pumping money out of that printer again? What do you think happens? Well, the answer is, it depends how much they print, but it could be very well to the point of which systematic risk decreases even though inflation and interest rates increase, and we get a period of relief in the market, even with inflation and interest rates increasing. So that's something to also point out. And then you would ask, well, why would the government allow interest rates to continue to rise and inflation to continue to rise, affecting consumers, mainly affecting retail, whilst printing more money? Well, it comes to this like more conspiracy theory point of view. It's like the government can't really allow the market to crash, because they know if it does crash any more than it already has, it will wipe out massive amounts of wealth from the wealthy individuals. It would be counterintuitive to what they desire. If interest rates drop, if inflation actually drops, governments make less money. Government's revenue is incredibly high with high inflation. So that's what I was talking about before, funding economic growth through inflation. They wouldn't actually hate that inflation stays high. They would want to try control the movement. Oh, sorry, there goes an alert for a coin. They would want to wait for that joke. They would want to control the rate of which it moves. So they could tell us we're going to increase interest rates forever for the next 4 years. But behind the scenes, they're altering the impact of that has on the economy by adjusting how much money they're printing. So it's really a tricky one, because at the end of the day, we don't know for sure what's going to happen. We can speculate.
We don't know for sure. That's correct.
We can speculate. Yeah. Anyway, that's basically what my answer was. Did you have a second question to that, or was that it?
Well, I suppose, yeah. I mean, we are speculating, and I agree with you. There are lots of potential things that could happen that could kind of confuse us even more, like the government printing more money, the Federal Reserve printing more money while rates go up, which kind of just confuses everyone except the people who really know what's going on. But I suppose the point is, like, what's probable, what's likely, and what's likely to me is they just do what they've done every time we've seen a recession. And in that case, as I said before, it's probably unlikely for the markets to bottom out while rates are still hiking, and it's probably likely they'll continue to rise, to hike those rates. Do you understand what I mean? So that's probable, and so given the probability, it seems unlikely to me that the bottom is in at this point. I'm open to it. I'm still, I'm kind of waiting to buy the reversal, not the bottom, so I don't really care too much. I'm open to the bottom being in, but it just seems unlikely.
Yeah, so then it goes on. Sorry, Wolf. It goes on to that saying. It's like you just said that. I just got to quickly interject with this, but it's quite important. Sure. It's like if systematic risk isn't currently moving, but systematic risk is consistent or constant, right? It doesn't change unless it's changed. We can agree on that, right? If it hasn't changed right now, or it's not changing right now, there is a potential the bottom's in, because we can only say that rates are going to rise, or rates have risen when rates have risen. And then when they do rise, they have that negative effect. So until that happens, it hasn't happened. And therefore, the charts aren't reflecting that possibility. So that's like kind of where I stand a little bit.
Yeah. Okay. So yeah. Okay. So I think we'll kind of edge away from this a little bit, and we'll talk about the 4-year cycle, because I know you. I mean, I think I don't want to misquote you. I think you'd agree the 4-year cycle is a thing, right? I'm not really sure what your opinions on the 4-year cycle are. I know that I have a 4-year cycle chart. I think first and foremost, I'll bring it up. I'll explain what I think about it, and then you can kind of talk about what you think about it. I think that's probably the best way to go in getting around this. Now, viewers of Wolves of Crypto know very well what the 4-year cycle is. I talk about it quite often. Every second video I talk about it. It's a date range trend. It's not trying to predict price, right? That's very important. There's nothing to do with price in the 4-year cycle, in my opinion, or nothing that I can see that's very clear. I don't care. It's not trying to predict where the top is, where the bottom is. It's trying to predict when. When is that going to happen? And so it's a date range trend. And technically speaking, it's basically just one big fractal that's played out really well. And it's based off the halving. So it's not based on nothing like most fractals. It's actually based on the halving. And the halving, obviously, is when mining rewards half on Bitcoin. Happens every 4 years, roughly. And so that kind of triggers the 4-year cycle. Triggered here back in 2012. That was when the 4-year cycle first became a thing. We saw the first bull market. We saw a bear market, bull market, bear market, bull market. Now we're seeing a bear market again. And essentially, it's a date range trend. So you can see we've got these color-coded, pieces of information up here. And it matches up with the color-coded measurements we've got here. So essentially 1,400 days from top to top, 1,400 days from bottom to bottom, 400 days roughly from top to bottom, 1,064 days from bottom to top. So it's a date range trend. If we extrapolate that date range trend, we can get a pretty good idea, or not a pretty good idea, but a rough idea of where the bottom's going to be, where the top's going to be in the future. And I've just kind of whipped up what I think it would look like. So essentially using this date range trend, we can predict roughly. And again, it's so rough that I can't even give you a month for it. I'm giving you a quarter for it, right? We can predict that Q4 is going to be the bottom. If we had to go right off to the T on the prediction, it would be November, but I think it's way too rough to do that. I'm going to say Q4 would be the bottom as per what the 4-year cycle suggests, right? So that's what the 4-year cycle is. And I think that, as I said before, I think that lines up relatively well with what the likely scenario is in terms of the macro situation. And I think my major problem with this, this uptrending line is the fact that it doesn't line up with 4-year cycle. It doesn't line up with the main probability of what the macro situation is going to be in Q4. Now, with that said, before I let you respond to the 4-year cycle, with that said, I'm still holding major significance to this line, and I'm still open to it being valid as the bottom if we see a trend reversal, which would come as a break above this major red box, right? So that's my opinion. I'll let you kind of talk about the 4-year cycle here.
Yeah, so I don't like. I would be stupid to say I disagree with a 4-year cycle. I definitely believe there's some sort of cycle for Bitcoin. Of course, my entire uptrending line is based on the premise that we do have a definitive cycle for crypto. Like we have these upswings, we have these downswings. It's very, very evident.
Yeah.
What I would disagree with, however, I go ahead and screen share my chart.
Sure.
Hopefully everyone can see this now. Is that I believe that the top for Bitcoin was just located at a different point in which you have described in your chart. And I believe the top was located here. This is the blow off top. And this was just nothing more than an overcorrection or an overextension, which resulted in that bear market rejection. Was when we had this bear market rejection here, and here, that resulted that top and that bear market started. But in essence, the top was actually at that blow off top above this trend line. So if we go ahead and use those date ranges on this chart, we'll notice that the date ranges don't in fact actually match up, and they don't actually tell us anything. So then you could argue that, I know this is going to sound quite aggressive, and I definitely don't mean it to come across as aggressive,
sure,
but you could even argue that the date ranges you used were just cherry picked to fit a narrative. I'm not saying you did that. I'm not saying you did that at all. I'm definitely not accusing you of doing that. But what I'm trying to say is it's almost like when you use date ranges, you're actually trying to find data to fit what you want it to be. So it's like almost less objective in comparison to trend lines, because trend lines are objective, date ranges are up to speculation. So it's like, how much significance can we place on that 4-year cycle target if we expect the top to be on the 29th of October and expected bottom in later in the year? How much significance can we place on that to predict the bottom? And that's kind of where I kind of move away from you on a more extreme point on that 4-year cycle, is I just don't believe that that top was in fact in October or November. I believe it will happen in March, April.
Yeah, okay. So, yeah, I've heard that point a few times. I don't really have a clear response to it, mainly because I think that, although you have a chart here, I think it's kind of speculative. It's like, well, if the top wasn't there, why did it happen to a certain extent? And it's like, we did reach an all-time high there, and that's the reality. And the 4-year cycle is basing the date ranges on when we saw the all-time high. So whether it was a fake out or not, that's where I have to measure it from by default. So, I understand what you mean, and I understand what you mean in relation to this macro chart, but I think it's kind of hard to talk about, because I suppose it just did happen.
Yeah.
I don't.
It's a tricky one because it's almost like the price doesn't match the concept.
Yes,
Because
that's correct.
in this trend and this chart, we see that we have this push upwards of Bitcoin, a rejection, and then this blow off top, and that blow off top when altcoins rally. We saw that exact same thing: a push upwards, a rejection, a blow off top, altcoins rally. Then we had this drop down, the significant crash down, which we saw over here. We saw over here, and a rally back up to retest that trend line, a rally back up to retest that trend line, and rejection. That rejection marked when that bear market really kicked into gear, where we started that aggressive downtrend towards that 200-day moving average, which is exactly what we saw. So if we're looking at fractals, like this fractal is actually incredibly accurate as well. So it's like one of those things. It's like we don't really know the truth until after the fact. But for me, it's just a personal opinion. I put more significance on trend lines and date ranges. That's just me.
But well, I actually would as well. I'll be honest with you, I actually would as well. But what I would say is that it seems to me that there's too much data there for it to be a coincidence. That's just how I look at it, and that's how I kind of speak about it quite often. There's too much data for it to be a coincidence. If it was, I think I'll just screen share here quickly.
Sure.
Just so we can wrap this. Yeah. Let me just get my screen up. So this is what I've gone over this before a little bit, and I actually have proposed this to the Wolfpack quite a bit. So if we bring it back and we say that as per the 4-year cycle, this was the top back here in April, right? It's like, well, then obviously everything doesn't match up anymore. Nothing really works, because that would mean that the bottom would be in April 2022, which is already passed, and we didn't see the bottom in April 2022. And so if we go back and we say that, hey, the top was actually in November here, and that's how we're going to measure it by the 4-year cycle, everything lines up again. We've got 1,400 days on all these occurrences lining up. We've got exactly 1,064 days from bottom to top lining up perfectly. It's like there's a lot of data here that would just make it, either a massive coincidence or an actual valid trend. And I suppose we're not going to be able to come to some sort of agreement here, I don't think. What we can say decisively is that we will find out over the next year, because when that actual bottom is formed and when we can look back at it and say, that was objectively the bottom, the bear market bottom, we will be able to tell whether the 4-year cycle, as I've got it here, is valid, or we will be able to tell whether the macro trend there you got there is valid. I think that there's not enough strong counterpoints for each of the charts to kind of decisively say either one is decisively incorrect. It's just kind of speculation based off limited data. Would you agree with that?
I would agree, and I definitely would actually like this chart to be correct, because
yes,
it would represent a much more clear, distinctive pattern in terms of date ranges, so you know what to expect in the future. Because like I said, the chart that I showed you, the date ranges aren't the key deciding factor. The price, I would say, swings are more of the deciding factor of where the top and bottoms are.
Yeah, that's correct. I think that's a really good point. They're just two different ways of kind of conceptualizing the kind of charts. It's like this one's a date-based way and the other one's a price-based range. What I would say is that the reason why I'm inclined to believe the 4-year cycle trend is very much, in fact, real as the way I've got it is because the whole concept of a halving happens every 4 years, which is in fact a date range. And so it would make sense to me that there are other date ranges that could be found there. But, again, I don't think we're going to come to agreement on it. But with that said, I think we can get into the last kind of aspects of this video. Do you have anything else you want to talk about?
I think I pretty much talked about everything I want to talk about. It was more of a discussion today's video between me and you, talking about our own personal charts, not opinions. Of course, we don't use opinions. We just look at the data and reflect the data. I think we will do one. I just want to say this: when it comes to analysis, guys, a lot of people have opinions. I speak for myself and I speak for Wolf, and Wolf, of course, I'm going to speak for you here. And if I screw anything up, just let me know. We don't have personal opinions. We look at the data and we translate the charts. We are basically translators. All right. We look at data, we look at the charts, we look at trend lines, we look at all the information, and we tell you what it is saying. That is all we're doing. And based on what it's saying, we give you probabilities of outcomes. And as traders, we react based on probability. We use risk reward ratios to react on more favorable probabilities to make money or short. And that is basically what we're saying. So when people say, oh, Wolf, you're too bearish here, or Whale, you're too bullish here, you're not really grasping what we're saying, because we're not actually bullish or bearish. I've never been bullish or bearish. I have only expected the price to go in a direction based on data. and I'm not bearish. It's just the reality of the price. So the price moves down. That doesn't make me bearish. That just means the price moving down. That just means the price is moving down. And I think a lot of people need to kind of drop the idea that if you're not bullish, you're bearish, and if you're not bearish, you're bullish, because traders, we don't walk around saying, oh mate, you're bearish, or mate, you're bullish. We just trade. We just trade the trend. We don't care. And I think if you're getting caught up in being bearish, or I'm bearish because I expect this, or I'm bullish because I expect this, what you're doing is you're psychologically wiring yourself to expect or to have confirmation for a certain direction, and you're blinding yourself to the other potential, because the market moves up and down. But if you just expect it to move down, you're blinding yourself to the other whole half of the market, which is upwards moves. So you're losing, essentially.
Yes. Yeah. I think that the easier way to describe it would be based on the price action that I've seen and based on the data that I looked at. I think that the chart is bullish, or I think the chart is bearish, or I think that the most likely scenario is this. It's not necessarily opinion. It's formed on the data that you've looked at. I think it becomes an opinion when you're not educated on the charts.
Correct.
I think that's a good way to think about it. But yeah, cool. I think we'll wrap it up there. Before we wrap it up, though, obviously, I want to talk about the Crypto Academy. Myself and Whale have created this earlier in the year. We worked on it for months, day and night, as some would say, to create Become a Trader, a 10-unit course, basically teaching you TA. Not only TA as well, we also go into fundamentals a little bit, where we're teaching you basically what is Bitcoin, what is crypto, what is fiat, what is money in general, how does the financial market move, how does the price go up or down, and then we go from that, which is to some people a very basic concept, and we expand on that progressively throughout the units, and the other kind of 9 units there are very, very important units, including and not even limited to we've got market mindsets, market psychology, we've got candlesticks, indicators, market patterns, everything. And so if you want to learn how to trade, and it doesn't really matter what level of trading you're at, what level of knowledge you are at, it takes through everything. So you can be a complete in fact, you probably don't even need to know what a dollar is, and you can do this course. And I'm not trying to just sell you in a cheesy way here, but that's genuinely how we made the course. You're meant to have, or you can have, literally no knowledge on money, and you can go in that course and get something out of it. Or alternatively, you can be a competent trader and you can expand your knowledge, objectively even more through this course. So if you're interested in that, go ahead. First and foremost, check out our Trustpilot. We haven't got many reviews on there yet because a lot of the students are still working through the course. But what I can say is we have over 100 students, and I've seen pretty much nothing but positive feedback there. Go ahead and check us an email here, cryptoacademycourses@gmail.com. And we'll get back to you. We'll send you a very informative pamphlet or document, which kind of shows you what the course looks like, payment information, everything you need to know about it. So go ahead and check us an email or check out the website. I think we'll end up the video there. Thanks for watching, guys. Hope you enjoyed. Cheers.